everyone. Welcome to Kroll's ALTLOOK quarterly market update for Q2 2024. I hope everyone is enjoying the unofficial beginning to the summer. And so we can go ahead and get started. So while this is a valuation-focused webinar, just as a reminder, although we are the largest valuation provider in the world, we do perform other services, including but not limited to restructuring, fairness opinions, compliance, corporate finance, cyber risk, ESG, and investigations and disputes, to name a few. So let me move into a few quick housekeeping items. This webinar is being broadcast live. We suggest you enlarge your media player to full screen when viewing the presentation. We encourage you to submit questions throughout the presentation, and you can submit those questions electronically through the webcast console labeled Q&A widget. If we don't have a chance to address every question at the end, we will be sure to follow up with you directly after the presentation. And then as a reminder, a recording of today's webinar will be posted to our website over the next few days. We do hold these sessions on the first Thursday of the last month of each quarter. So our next call will be on Thursday, September 5th. We do generally limit these presentations to about 45 minutes. And each quarter, we will focus on 3 main topics with a few slight variations, but there'll be recent regulatory developments, quarterly capital market and macroeconomic developments, and valuation hot topics and questions. So just to introduce the speakers very quickly, I am Jenetta Mason, a managing director in our alternative advisory practice. I'm joined by 3 of my colleagues today: Carty, a managing director in our private capital markets digital group; Larsen and Peter Salvatori, also managing directors in our alternative asset advisory practice. So with that, I will turn it over to Larsen for a regulatory update.
Thank you, Jenetta. It's good to be here today. Just want to hit a few things quickly. I think as I look at the slide, I tried to get it updated, but the new slide did not get updated. I apologize for that from last night. As many of you may know, there was a federal appeals court yesterday that vacated the private funds rule. So I was going to speak about the new private fund rule and when it was effective and so forth. It has now been vacated. So the rule has been effectively stayed by the appeals court. It's unclear yet whether the SEC will go back and whether they will effectively appeal to the Supreme Court. It is interesting. When this rule, the private fund advisor rule, was being debated by they sent it out for exposure. We were one of those who commented on the rule. The commissioners were then debating prior to adopting the rule. And as I listened live to the debate of the 5 commissioners, 3 of the commissioners voted in favor, 2 of the commissioners voted against, and the 2 who voted against highlighted that they felt that the SEC had far exceeded their statutory authority. It appears as though that's what the appeals court also agreed. Now, from a practical perspective, does it change much? We still, for many funds in your fund agreement, you still have to provide quarterly reporting. You may not have to give the performance reporting that the rule required related to IRR and multiple of invested capital, but you still do quarterly reporting. Independently, and interestingly, just a few days ago, ILPA released for comment, the Institutional Limited Partners Association, a exposure of their updated templates, which are their quarterly reporting template and their cash flow template. So it's possible that they may be asking for some of the same information that the SEC was going to require. So from a practical perspective, I'm not sure that it really changes too much. It probably means that at a minimum, funds are not going to have the regulatory arm of the SEC saying, did you report IRR the way we wanted you to? But investors still need information. They still need quarterly information. So not a huge change with the rule being vacated. Many funds also have audit requirements. So again, that's not a huge change. The fairness opinion or valuation opinion for advisor-led secondaries, now that's no longer in the rules. That said, it was best practice for most large funds to obtain a fairness opinion in the context of an advisor-led secondary, just for their own internal compliance purposes. So while it's no longer required, I think it still continues to be best practice to seek out a fairness opinion from in the context of advisor-led secondaries, or when you're moving something from one fund to the other. I know that our opinions business is very active in that space. Many of you may be aware of, I think I've highlighted in the past, but I just wanted to re-highlight the International Accounting Standards Board formed several years ago, the International Sustainability Standards Board, which is tied to the IASB. They have issued their first two pronouncements. It's called IFRS S1 and S2. S1 is general requirements. S2 is climate-related disclosures. Those two were both issued and effective at the end of 2023. It's probably worth your time to become familiar with them. They're not specifically required as of today, but they're voluntarily required. And over time, it's likely that they will have more and more of an impact. I think I've also highlighted in the past that the International Valuation Standards Council released their updated International Valuation Standards. The newest, it's now in print. It's available on the IVSC website. It's effective for January of 2025. One of the questions that really comes from there, and we'll touch on this when we get to our kind of hot topics at the end of our session today, is how are we dealing with ESG factors? So I think I'll stop there from an overall regulatory perspective. Again, that the vacating of the private funds rule is the big news, and we'll see how that plays itself out, whether that the SEC ends up taking that to the Supreme Court or not. So with that, why don't I turn things over to Peter and Lee to give us our economic update.
Thanks, David. So the objective here of this next section is to give a very brief economic overview, go through some key observations on public and private asset classes, and give some key valuation takeaways for Q2. So to begin, I'm going to give the floor here to my colleague, Lee Carty, who will go through our private loan market overview using our internal database. Lee, the floor is yours.
Thank you, Peter. I'll be talking through some results from our database of performing private credit valuations in order to summarize what we're seeing in this market. Kroll's been active in this space, has been a leader in this space for nearly 20 years, and in the course of conducting that business, has amassed a large amount of data from which we can derive aggregations that provide insight into the market structure and the market's performance. What's remarkable about these data is that they're drawn from one of the more opaque segments of the private credit market, the middle market. And that makes insights derived from them particularly valuable. The results I'm sharing with you today are preliminary in the sense that while we have a large enough data set to deliver meaningful results, we're still building it up, particularly historically. We have a beta version of our benchmarking capabilities on our valuation platform, which I encourage you to use. If you don't already have access, please reach out and I'll make sure that you do. With that said, let's take a look at the data. So since the Federal Reserve put its rate hike campaign on hold in the middle of last year, common short-term benchmark interest rates have leveled off. If you look at the chart in the upper right-hand side of this slide, you can see, for example, that 3-month term SOFR has really remained flat. It's narrowed by less than 3 basis points since July of last year when the Fed last raised rates. Now let's move into loans, and to anchor our observations about loans, we're going to narrow the scope and look really just at first lien performing U.S. dollar company loans. Okay, for these loans and for this period, the same period since July of last year, there's been a really very substantial tightening of spreads. The spread that we're talking about in this context is either the difference between the yield to maturity and the swap rate at the same maturity as the underlying loan in the case where we have a market value, or it's the spread that our analysts use in building up the discount rate that's used for generating the fair value. And since July of 2023, these spreads have tightened by 71 basis points to finish April of this year at 681 basis points. That tightening brings us back to the lows, or very nearly back to the lows that we saw before the Federal Reserve started raising rates. Moving over to the next slide, the combination of flat benchmark interest rates and falling spreads has pulled loan yields down as well. If you look at the chart in the upper right-hand section of this slide, you can see that the trend of falling yields that we highlighted last quarter has continued. The yields we use in these calculations are, similarly to the spreads, it's either the yield to maturity where our value is a market value, or it's the discount rate that our analysts have derived in order to generate the fair value. And the chart highlights that yields have pulled in by very similar amounts to the spreads, having fallen by 83 basis points since July of 2023. They finished April at 11.08%. With falling yields, valuations have continued the rally that they started when the Federal Reserve began raising interest rates. Since that campaign paused last year, the fair value percent of par has increased by another 53 basis points to finish April of this year at 98.712%. Now, one of the very big impacts of this notable tightening in spreads is that it's been driving a compression in margins. Okay, so the tightening of spreads has increased fair values, and it's benefited borrowers as they've been able to prepay or renegotiate and generate a decline in observed loan margins. And here we're talking about the contractual rate that a borrower is going to pay over a stated benchmark rate in a floating rate instrument. If you look at the upper right-hand corner, we plot the par-weighted average margin of the loans under consideration, that is first lien U.S. dollar company loans. It highlights a long-term downward trend that took a pause during the Fed's rate increases, but continued its downward trajectory immediately after those hikes stopped. At the end of April 2024, but what's important here, or one important fact of this trend downwards, is that it's an average, and it hides the dispersion and the factors that are driving different types of loans towards this trend. In the lower chart, we segmented these first lien loans between larger issuers and smaller issuers. Last quarter, we looked at issues. Here, we're looking at issues. And for this company-based size segmentation, we primarily used EBITDA where we could. And we classified companies with between 100 million and 250 million in EBITDA as the upper third of the middle market, and those with between 0 and 25 million as the lower third of the middle market. If we didn't have EBITDA, then we fell back onto a waterfall of size measures, beginning with revenue, moving to total debt, moving to total issuance. The result is a segmentation of the middle market between large, medium, and small companies. And the chart at the bottom there plots the par-weighted margin for these two segments, and it reveals a persistently higher margin for the lower middle market obligors. That's the blue line, which to this day remains above 6%. The upper middle market obligors are shown in the lower line, the orange line, and they show a more marked decline. The larger companies have seen margins decline substantially relative to their pre-COVID levels and have ended April 2024 at below 5% at 4.62%. Not only is it the borrower size a factor, but there's also other factors that are driving this. So for example, longer dated loans have lower margins than shorter dated loans. The chart on the upper right shows the trend in par weighted margins for long dated loans, defined as those with more than 4 years remaining to maturity, stated maturity, and short dated loans, defined as those with less than 4 years remaining to stated maturity. The difference in average margins is clear. If you look at the chart at the lower right, you'll see that obligor size is also positively correlated with loan term, and that larger companies issue longer term loans. And so larger borrowers of longer dated loans are one area where margin declines have been most noticeable. And it's also an area to keep an eye on for further margin compression if spreads continue to tighten next quarter. That's what I have prepared for you today. Please don't hesitate to reach out to me at the address in this presentation if you have any questions, comments, or suggestions. With that, I'll hand the mic back to you, Peter. Thank you.
Thanks, Lee. So to begin the economy, the theme really in the last 12 months continues to kind of play out and stay the same. So, large cap tech continues to lead. Short and long-term rates are pretty much in the same place quarter over quarter. Employment remains strong with the unemployment rate remaining sub 4%. And while there's certainly many narratives out there about the consumer being pressured by the persistent inflation, they still continue to spend. So the market is now on the interest rate front at a consensus that the Fed's done tightening. What continues to change, however, is just when that's going to start and for how long. So 6 months ago, the market was expecting cuts to begin in March of this year. Clearly, that did not happen, with as many as 6 25 basis point cuts throughout the course of this year. So last quarter, 3 months ago, expectations were for cuts to begin this month here in June, with as many as 3 25 basis point cuts in the back half of this year. And clearly still hasn't happened. So presently, consensus is for possibly just one cut and maybe even no cuts this year. But really it changes by the day. I think after the JOLTS report this week, as well as the ADP report yesterday, which came in a bit soft. Both actually came in a bit soft. The needle moved a little bit, and there's some speculation that we could see a cut as soon as September. So there's several Fed governors on record of saying it won't be appropriate to even begin cuts until there's greater confidence inflation is under sufficient control, and that the data has shown at least a few months of steady inflation declines. So the current cut cycle is now expected to stretch here now into 2026. Many now project the terminal Fed rate to end up somewhere in between 3% and 4%. So while cuts seem inevitable, the path to a normalized environment is still long and uncertain, and likely to end up here at a terminal rate that will be significantly higher than the decade plus preceding the pandemic. And then lastly, as I mentioned earlier here, the JOLTS report on Tuesday surprised a bit to the downside. This has been a popular report for investors, that and the ADP report. Right, too many job openings or a surprise to the upside. It's an indicator of an overheating labor market and thus potential future inflation pressures. And in that environment or in that situation, you've seen equity sharply sell off bonds as well, which means increased yield. On Tuesday, however, it came in a bit light. That's kind of what the market's looking to see. And we saw a modest rise in equities, and actually bond prices went up by a good bit. I think the 10-year saw yields drop by about 10 basis points on Tuesday alone, or thereabout. On the next slide, we have a very broad and detailed overview here on the public equity performance. Generally speaking here for Q2, we had broad declines in April, with May clawing most, if not all, of those losses back. The 2023 theme has carried here into 2024, which is to say much of the gains here on the public side still remain very concentrated in large cap tech, and actually even more specifically in businesses that are leading in the AI space. This is evidenced by the NASDAQ and to a lesser extent S&P's performance. The Russell 2000, which tilts small cap, has year-to-date gains through May of this year of just 2.1%. This compares to S&P and NASDAQ gains of 10.6% and 11.5% respectively. Lee did a great job here on the private credit, so I'll only briefly go into a couple things here on the broadly syndicated loan market. So similar to what we're seeing here on the private side, the broadly syndicated loan market spreads have come in quarter to date and year to date as well. So you're definitely seeing an alignment here in movement. As I've highlighted here in previous quarters, when applying this data to private deals, we as a practice tend to benchmark either to the smaller indices or the smaller market cap indices, if we will, so the middle market, or to the lower rated indices such as a B rated index and sometimes a double B. So from a size and credit quality perspective, we find the underlying securities in these benchmarks to most closely reflect the underlying risk of private credit deals we routinely value. On commodities side of the house here, there have been a couple notable developments. OPEC Plus here on this past Sunday agreed to extend the total of 5.9 million barrels per day of output restrictions. So within this broader figure of the exporter group, 3.7 million barrels per day of cuts that were due to expire here at the end of this month were extended until the end of next year, 2025. And then within that figure, there were voluntary reductions of 2.2 million barrels per day by 8 members, including Saudi Arabia and Russia, which were prolonged 3 months to the end of September of this year. And it's this rollback that surprised the market a bit. That was expected to be extended a little further than just 3 months. So you're going to have a little bit more volume coming to market, which was a bit unexpected by many. And you saw that in some price action with WTI going down to low 70s earlier in the week, and it's presently, I think, around $75 a barrel, which is down from 85 at the end of last quarter. Lastly here, gold continues to grind higher, as well as Bitcoin. Gold 23.50 an ounce, Bitcoin now, it depends really on the minute, but around 71,000 a coin as of me speaking here. So here on just some key asset classes, a couple notable highlights. So for the first half of this year, we've seen high repricing activity in the private credit market, as well as significant competition from the broadly syndicated market. And I think you saw that in Lee's data there, especially where you saw the larger businesses, some more significant price action for those deals. And I think that's partly you could perhaps correlate to incoming competition from that end market. So Q1, Q2 of this year, repricings have been as significant as 25 basis points, up to 100 basis points below the legacy facility. I'll note here that this is a limited sample, and there's likely to be some selection bias here in a sense that the repricings are most likely to affect the best performing credits. Nevertheless, this serves to be a good comp data for those positions that are performing well. LBO purchase multiples remain depressed. There's a consensus that deal activity is expected to pick up, and I know that's been a bit of a drumbeat here over the last couple quarters. But now you also have, kind of LPs coming into the mix, getting anxious to get some capital back to start their recycling process. And then venture remains relatively unchanged quarter over quarter. So it's still challenged. It's still difficult environment to raise capital. However, there are pockets where you're starting to see some excitement, obviously, and notably anything that's really related to AI. Real estate, really the hot topic, if you will, is still the office environment. Demand continues to shrink. Vacancies are now approaching 14% across the U.S. and cumulative negative absorption is now up to 210 million square feet here since really the beginning of the pandemic. So when you marry that with asking rents continuing to dip, cap rates continuing to increase, and kind of the office attendance patterns really now all but leveling off, these forces are really now driving down valuations, even in investment grade buildings. And you're starting to see some data points where valuations are now down 35, as much as 40% since 2021. And this actually exceeds what we saw during the great financial crisis, and many predict more pain to come here still in that end market. So finally here, thematically, from a valuation standpoint, I would say Q2 is pretty similar to Q1 and Q4 even of last year. Rates still remain elevated. Multiples are relatively unchanged. This is on the LBO side. And having said this, the points we've highlighted are really unchanged from Q1. I think the only new concept we added this quarter here is that due to the lack of PE-backed exits over the last couple of years, you're starting to see a standoff of sorts between lenders, shareholders, and LPs, right? So it's well documented. Private equity's been holding out, hopefully to see a better exit environment, i.e. lower interest rates. So for some deals, however, loan maturities are going to start becoming an issue here. So for many, refinance or amendment is an easy solution. For others, I've seen a number of deals where that's not just really a possibility. Think transactions where you have EBITDA to interest at just maybe barely over 1 time, and leverage in the high 5s, 6s on a leverage basis. So from a valuation standpoint, if you're valuing either the debt and equity in those situations, I think you at least need to start asking the question about how a likely exit will unfold. So some deals might require incremental equity check to deleverage and appease lenders. For the incumbent lenders, it may mean some form of maturity extension. And there's many other permutations these kind of situations can take. Again, I think the takeaway here is just to start with identifying these deals and start asking the questions. That's all I have for now. David, I'll pass things back to you.
Thanks, Peter. Just Jenetta, I don't know if we've got anything that we need to touch before we kind of jump in here.
Yeah, I think there was a question on the spreads quarter over quarter, and I think Peter covered that in the data that he showed. So thank you for that, Peter. So yeah, I think we can go on into hot topics, David.
Thank you. So these are just a few concepts or questions that have been seem to be being asked repeatedly over the last quarter. There's a number of them. Again, if you've got any that you'd like to ask, we're happy to try to address those today. But interestingly, I think that maybe it was way back in February, so maybe we touched a little bit about this last quarter, but there's been there was an article that kind of took to task whether or not credit investments were being properly valued. There's been another kind of high profile article going after some of the maybe REIT valuations. There's also, I think I recently saw questions about bank loans and whether or not they have a pending cliff of defaults coming. So all of those kind of raise the question. It's interesting. I'm not sure if it's just slow news day. I'm not sure if what it is that's causing private credit, private equity to be more of a lightning rod in the current environment. but there's a good number of LPs legitimately that are asking questions, in part because of these news articles and just because of the overall environment, to say, all right, are we doing a good job with valuation? And I think as we highlighted through the data, there's not huge market movements. There is some tightening in spreads. There is some impact, but there's not huge movements. But I think what that means is that those who are doing a good job and historically have done a good job of taking into account data, identifying what would a market participant pay for a given investment as of each quarter end, generally I feel like they're doing a good job in coming to value. And yes, they are properly valued. Are there still pockets of managers out there that, for lack of a better word, may have their head in the sand, where they say, well, nothing's really changed. I don't really have to think about it. I'm just going to keep things at where they are. I think that is short-sighted. Really, you need to do a robust analysis each time you report to investors of what would I receive in that orderly transaction. Are things tighter? Can I get the financing in an LBO? Can I get the multiples that I think? Is the EBITDA sustainable? So all of those things are need to be taken into account each time we value. Again, if we're doing a robust job, we should continue to do it. If we're not, we should start doing a better job. Another question that seems like it's coming up a little bit more and more is the whole secondary market for fund interests, and what does that mean in the context of fair value? And I think there's a couple of different pieces to that. One is, if I'm thinking about an individual portfolio company secondary transaction, yes, I need to take that into account. I need to think about that. And if I'm thinking about a fund interest, well, fund interests have this unique ability or unique provision in the accounting literature called the practical expedient, where a fund interest can be valued at the net asset value if the net asset value is as of the measurement date and is based on the fair value of underlying investments. So the fact that you are buying that a secondary player may be buying a secondary interest at a discount, well, that may be true, but a discount to what, as of when? That information is rarely available, at least to the wider view. So way back in 2007, FASB decided that you effectively could run the risk of double discounting if you valued purely on a secondary basis, because the initial investor would, let's say, invest in a fund of funds. The fund of funds invest in an underlying fund. When that underlying fund reports, you have to take a discount there. The fund of funds would then have to take a discount, and the ultimate investor would effectively double discount. That doesn't seem to make sense, that you would layer in discount on discount. And fundamentally, one of the major reasons we have the practical expedient is if the manager is doing a good job of reporting fair value, hypothetically, all of those investments are sold at the measurement date, and that's the exact amount of cash that would flow to the investor. So that's why the practical expedient makes some sense. So yes, it has to be taken into account. No, you don't have to use the practical expedient, but it's something to be thought about, but it does not necessarily mean that everybody needs to write down their fund interests and depress the overall market. I mentioned that the IVSC has new rules. The IASB has rules with respect to ESG and sustainability. From a fair value perspective, I think the key thought there is that we're capturing all of the impacts, the future cash flows, which are known and knowable. And those could be the future regulatory cost to report. They could be the need to reduce a carbon footprint. They could be the need to invest in technology to identify or purchase services to identify climate risk. And again, what impact does that have on cash flows? So fundamentally, from a value perspective, ESG and sustainability, I could argue, doesn't really mean anything different than any other cost or any other revenue. But the fundamental question is, have we captured them all? Have we thought about it to identify what's my future cost? Is that embedded in my future, in my cash flows? What's my future benefit? Is that embedded in my cash flows? And have I taken that into account to the extent it is measurable, i.e. known and knowable? There will be, there's disclosure that's coming. That's where IASB will start. And with that disclosure, maybe things will become more measurable. But it's something that we all should be taking into account. Maybe we don't disaggregate it, but we need to be able to articulate how did we take into account the impact in the future. I'll just add one more piece. I'm discussing with a very large company their future labor force. How can they attract the type of employee that they need and want? Well, that's part of sustainability. That's part of the social question. The flip side of that is what is AI going to do, and is that going to reduce the need for employees? So those are some of the questions that are out there. Another question that seems to be more prevalent than I think it should, and we're getting this, I've seen this from selected audit teams or the valuation teams from auditors, is a focus on valuation process with almost the exact same amount of emphasis as the valuation conclusion. So if a fair value conclusion is supportable, and let's say the fair value conclusion is 100, should it matter? Does it matter how I get there? Some auditors seem to think that it does. So I just highlight that thought process is out there. I think as long as you've got a supportable basis on coming to your fair value conclusion, meaning that you can demonstrate why the 100 is where a market participant would transact if they were entering into an orderly transaction as of the measurement date. How you got there really shouldn't matter, doesn't matter. By the same token, you are encouraged to use a market approach, an income approach, possibly a replacement cost approach. And so you have to demonstrate that. But I just highlight that question is out there, and that's being less and less resolved. So I'll take a stop there. I do know, maybe, Peter, I'll throw this one back to you. That one of the questions that came in online is do we expect the real estate vacancies to be causing loan defaults? And is that effectively the article that I just referenced about banks, and there's a large number of banks that are teetering on default? Is it the real estate market that's driving that, or is it something else, or do we know?
So I guess was the genesis of the question, do we expect loan defaults coming out of the office real estate sector?
Yeah, or any of the real estate vacancies. Is that going to impact for large and regional banks defaults and effectively cause pressure on the banks, but also drive defaults?
Yeah, look, I think the playbook is a playbook we're all familiar with to amend, extend, pretend until you can no longer. But at some point, there's going to be, a moment when something has to get done, and those loans will default or get reworked. I think the real estate market's a bit different because you do have the banks involved, and not more traditional alternative managers. The banks, obviously do not want to be owners of half occupied real estate buildings. So you do have a little bit of a different dynamic there. So, it's a bit early yet to speculate how those transactions will unfold, whether, again, it's a default or some type of rework. But it's painfully obvious that there's a ton of impairment, certainly in the office end market. And, at some point, whether it's this year or next year, or, sometime soon after that, there'll be some form of transaction. And again, likely to be some type of restructuring, rework, default, something under that umbrella, for sure.
So let me stop there. Jenetta, I'll go back to you and see if you have seen any other questions, or maybe we are getting close to time to wind up.
Yeah, absolutely. So if there are any additional questions, again, as always, you can add them in here to the chat, or certainly you can send those over to us and we will respond to you directly. So thanks for everybody who have submitted questions so far. I guess with that, I'll just remind all that our next ALTLOOK valuation session will be on Thursday, September 5th. So you can mark your calendars for that. And we do have a few additional webinars coming up. Thank you for forwarding that to the next slide here. As you can see, there's a couple valuation webinars that are upcoming. I believe everyone should be able to click on the register now to get more information if you would like to register, if you know somebody who is interested in registering. Additionally, as I mentioned before, we have recorded this session. And so information on upcoming webinars will be distributed at that time when we notify everybody that the recording is available. And please note that these webinars are coming up. I believe one is next week, and then another one is towards the end of this month. From there, I would just like to thank everybody for joining the call today. And we do look forward to seeing you on our next webinar. So thanks, everybody. Have a wonderful day.